got a huge week ahead of us, especially from a top-down perspective, thanks to both economic and political developments. On the macro side, the big event's likely to be the 8th and final meeting of the US Federal Reserve for 2019, and that's due on the 10th and the 11th of December. Now, after 3 rate cuts this year of 1/4 percentage point each, Chair Jay Powell has already strongly hinted the Fed thinks it's done enough, at least for now. As a result, the market is putting a 95% chance on there being no change in the headline interest rate of 1.75%. However, keep an eye on any hints for 2020, when the market is currently pricing in a 53% chance of at least 1 cut of 1/4 point and only a 2% chance on any rate rises. Also watch for any comments on the Fed's balance sheet. Chair Powell has flatly denied that the central bank's $120 billion overnight intervention in the US repo or interbank funding market is quantitative easing by another name. But it is designed to keep the interbank overnight interest rate low, and it is leading to a fresh expansion in the Fed's assets, as we can see here looking at its balance sheet. Markets appear to be lapping up this fresh injection of cheap cash, and it could be one reason why US and global share prices seem determined to end the year with a fresh advance. But do think about these 2 issues. 1. The Fed has cut rates 3 times this year. Maybe that tells us the world's biggest economy and financial markets couldn't stand a headline US interest rate of just 2.5% for any more than 9 months. Second, the Fed is intervening in interbank funding markets presumably for a good reason. Who's to say that wasn't a big bank that was struggling for funding in September when the repo rate ballooned towards the 8 to 10% range? Now, if it was a big bank in trouble, that's not good. Equally, if it was, nobody's going to say. So yes, cheap cash is helping share prices, but what underlying fragilities could US monetary policy maybe be trying to mask? Now, on the political front, the UK general election takes place on Thursday the 12th of December. In theory, we'll know the identity of the victorious party and its leader, and thus the Prime Minister, by the early hours of Friday the 13th, no less. But on the basis of the results of the 2015 and 2017 elections, which threw up coalition governments, it might not pay to take too much for granted. Now that said, opinion polls appear to be giving the Conservatives a lead of some 10 to 12 percentage points, and at the moment this appears to be boosting sterling and to a degree UK equities too. I guess the theory here is as follows. First, financial markets have historically performed better under the Conservatives than Labour on average since the inception of the FTSE All-Share. We can see here that the 4 of the index's 5 best performances by PM come under Tory leaders and 4 of the 5 worst under Labour ones. Second, sterling is rallying at the moment as well, possibly in the view that the Conservative win will lead to a Brexit deal by the end of the transition period in December 2020, providing some certainty on that front, at least by trying to avoid a no-deal scenario. A big rally in sterling, though, could complicate matters, at least for the FTSE 100, since weakness in the pound has boosted the value of overseas earnings and the share price of overseas earners since the June 2016 referendum. A surge in the pound could therefore have the opposite effect in theory, so watch this space. Now, before we move on to the company stuff, please note that these are just comments on historical data when it comes to elections and the recent data when it comes to sterling. They are not, repeat, not an expression of political preference on behalf of myself or my employer, so please don't troll me about it on Twitter. And also remember, the past's no guarantee for the future. Now on the company front, this could be a good week to slip out bad news and a profit warning, so keep your eyes peeled, but only a handful of large, mid and small cap firms are due to update investors this week. They include motor finance and bridging finance provider S&U on Tuesday the 10th of December, Stagecoach and stricken retailer Ted Baker on the 11th, Ocado, TUI, Superdry, Dixon's Carphone, Purple Bricks and Serco on the 12th, and lucky for them, Balfour Beatty and Hollywood Bowl on Friday the 13th. But the biggest source of fuss in the week ahead could come in the form of the interim results that will be released by FTSE 100 member Ashtead, and they're due on Tuesday the 10th of December. As we can see here, the shares have done very well indeed over the past 12 months, despite concerns over world trade and whether the US economy is slowing down after a 10-year expansion. Perhaps one of the reasons why the equipment rental giant has seen its shares do so well is that investors may believe the combination of lower interest rates from the Federal Reserve and other central banks, added to a US-China trade deal, could mean that the American and global economies are back off to the races again in 2020. We can see here how Ashtead shares perhaps take some form of lead from the Manufacturing Purchasing Managers Indices, or PMIs, in America and the UK. And you can argue perhaps these indicators are bottoming after a marked slump. Now remember that Ashtead gets around 90% of its sales from its American Sunbelt operation, with the bulk of the rest coming from the A-plant business here in the UK. You could also say that investors had better be right, because if they are wrong and a slowdown or a recession comes around the corner unexpectedly, that could leave Ashtead shares pretty exposed. So this first half statement should be a very informative one. So when it comes to the numbers, analysts will be looking at three headline figures in particular. The first is sales. On a stated basis, analysts are looking for full year sales of around £5.2 billion against £4.4 billion, a 15% increase in the year to April 2020. Note that first quarter revenues, by the way, rose 17%. Ashtead will, in the interest of clarity, release a number which also adjusts for foreign exchange movements. The second number to watch is pre-tax profit. Percentage growth here has been running pretty consistently in the teens, although the rate advance did slow a little to 8% in the first quarter. For the whole of the year to April 2020, analysts are looking for a stated pre-tax profit of just over £1.2 billion against £1.06 billion a year ago. That's an increase of 16%. Three of the smaller items to watch, by the way, are the ongoing share buyback programme, due to run to at least £500 million in the year to April 2020, spending on bolt-on acquisitions, which came to £335 million in the first half a year ago, and particularly capital investment. If management's feeling bullish, it'll buy more kit to rent out. In the first half of last year, Ashtead spent £869 million, and management suggested that capex will come in broadly flat this year. And then to finish, the big final number, the third one, is the dividend. Last year, Ashtead distributed 40p a share to shareholders, and analysts are looking for a 9% increase to 43.8p. That would extend an impressive streak of increases that dates back to 2005. Note that the interim payment last year, by the way, as a base for comparison, was 6.5p a share. Thank you for watching, and I look forward to seeing you next time.